Peace. Welcome to Divine Forex. This is your host, Tyrone L. Back at it again. Today we're going to talk about risk management. How much should you risk per trade? We're going to make this real short and sweet. 2 to 4% per trade is what you should risk. 4% represents the builder or the foundation. It's a great space for a small account. You don't want to risk too little because it'll take too long to grow your account. Some people will tell you 4% is high, is too high, but if you have a decent trading strategy and you're winning 60 to 70 to 80% of your trades, then 4% you should be okay. If you hit a losing streak, I do recommend going down to 2%, but I would do 2% minimum, 4% max. Stay between 2 to 4%. And it's pretty easy to calculate. You basically want to take the amount you want to risk and just divide it by the amount of pips to your stop loss. So we'll get a calculator out, and I want to show you really quick how you would calculate, your risk size. So let's say you have a lot. Let's say you have an account with a $200. You have a $200 Forex account. Basically, you would take $200 and you would multiply that by 4%, and that is going to give you $8. So you would basically risk $8 on that trade. So let's go over to our chart here. We're going to go to Euro USD, and let's say I was looking for at this pair on a sell. What I would do is I would grab my measurement tool and I would measure from here to my stop loss. And this red line is going to be my stop loss, which is right above the previous candle. And we're at 38 pips, right? 38.9. So we'll just say 39 pips. So if I'm risking 39 pips, pull my calculator out, and I would say 8 divided by 39. That would give you 0.20. So basically, you would risk 20 cents per trade. Now, I like to try to double mine up, so I probably would do 2 positions of 10 cents, and that way I can close one position and leave the other open if I think it's going to continue to go. But I would do 2 positions of 10 cents, which would equal to 20 cents. So 2 to 4% per trade, and you want to always look for your first take profit, which you want to be a minimum of 2-to-1 ratio. So if my stop loss is here at 30, pretty much 39.40 pips, our take profit will be here, which is 85 pips. So that's a little over 2 times. So you would make about $16 while risking 8. And that would be your first take profit. And then obviously your second take profit would be down. When we look at this strategy here, 2 to 4%, like I said, 4% is what I like on smaller accounts. 2% if I have a bigger account. So if I got 300,000, then yeah, I might be doing 2%. But if I got a couple of $100, I'm going with 4%. And that's how you calculate your lot size. You don't want to overcomplicate things. You want to keep it simple. So there's a quick strategy that you can use for your risk management. Peace. And if you have any questions, reach out to us at Tyrone.com.